Hi, my name is Arun Sundaresan. I head product management at Nippon India Mutual Fund, one of the largest AMCs in India. So today I'm going to talk to you about the importance of global investing, precisely why it is important for Indian investors to consider investing into funds which invest outside of India. Now, before I begin, let me give you this data point. The total assets under management in international funds, ETFs, fund of funds, funds which directly invest into stocks abroad, all of them put together is roughly about 36,000 crore. The mutual fund industry is a little over 36 lakh crore. So which means that less than 1% of assets are in these global funds. So you get the picture here. Now, why is this happening? Perhaps because of what we call as home bias. Any investor believes that they understand the local market very well. When it comes to foreign markets, they think that they do not understand. It becomes foreign in quotes, and therefore, they're staying away. But what we need to think about is, I'll give you a different perspective here. Even when you're investing in India, indirectly or directly, without realizing, you are making foreign investments. So a lot of Indian companies have presence globally, physical presence globally. A lot of foreign MNCs operate out of India. We do a lot of exports, be it software exports or precious metals, etc. We import a lot, oil, electronic goods, etc. Then remittances happen. Foreigners, I mean Indians who are abroad, send foreign converted currency here. So that happens. Then you have foreign direct investments, foreign portfolio investments, FPI flows. All of these things actually, if you take into account, directly or indirectly, nearly a good part of our GDP and market components are anyway foreign. So it should not come as a surprise that investing abroad is very different, and therefore, it needs to be avoided. So this is point number one. So therefore, if by investing in India itself, we are doing this indirectly, is there a need to separately invest into these funds? The answer is a clear yes. For all that foreign linkages that we have, any country, including India, will have country-specific risk, or what we call as idiosyncratic risk. For very specific reasons peculiar to a country, it can be for various reasons. It can be a global risk aversion, and therefore people are not investing in emerging markets like India. Therefore, India takes much more correction than global markets. Or it could be specific regulations like taxes in India could have got increased, or there is a specific regulation or a banking NPA related issue, NBFC related issue, etc., which could hamper a particular country when the global markets do well. For example, we saw that in 2011, 2013, when the taper tantrum happened, 2016, 2018, 2019, and even the half of 2020, Indian markets actually did not do well when compared to global markets. Therefore, in those periods, on hindsight, if you had a little more of foreign funds also to your portfolio, it will help you diversify your portfolio. Now, this diversification is perhaps a overemphasized term. A lot of people do not understand this. Let me help you understand with a simple example. Suppose you start with 100 rupees and the market takes a big correction. For example, okay, you've invested only in Indian markets. The Indian markets takes a big correction. 100 becomes 50. Now, for you to regain 50 to become 100 again, markets will have to go up by 100%. On the other hand, if you are combined Indian investing with global investing, and because of that, you get a balanced out returns, you get diversification. You did not lose so much to start with. 100 became 80. Then another 25% will take you back to 100. So in investing, it is not always about gaining the most. You will also you will fare very well if you lose a little less, so that even with moderate gain, overall your return tends to be good. So this is the benefit of diversification. In some ways, you can think of this like a hare and tortoise race. So it is not always about running very fast and then coming to a stop, or kind of sleeping over, a slow, steady, diversified kind of a return profile eventually will, kind of get you to your destination. So that is what, diversification brings to the table. Very clearly, foreign investing brings to the table three advantages. One is that obviously you are getting into different geographies, which for all the global linkages that could be there, they tend to behave very differently from Indian markets from time to time. Sometimes it can be very different, sometimes it could be slightly different, but that brings to the table diversification. This is number one. The second point is that you get to invest into certain types of industries and companies which are not present in India. For example, in US, you have what are called as FANG companies, Facebook, likes of Google, Amazon, etc. You really do not have the equivalent of that in India. Likewise, Taiwan, for example, offers leadership in semiconductor, what are called as chips, electronic goods, etc., which again are not so prevalent in India. So you get to participate into unique profit pools, thereby, to that extent, diversification. Investing into foreign funds, currency also comes into play along with equity returns. If the underlying currency appreciates, especially if it is a developed market currency and it has an appreciating bias, that could also add to your return. So all these three aspects overall could work in investors' favor, which is why I think as investors, you should be open for foreign investing. It is not foreign after all. So with that, I would like to conclude. In fact, at Nippon India Mutual Fund, we are introducing a new fund offering, NFO, called as Nippon India Taiwan Equity Fund. If you find this space interesting, the global investing part interesting, you may want to check that out. We're doing a separate video on that. Thank you very much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.